Hello, this is Doug Gerlach, President of ICLUBcentral. Welcome to our Investment Club webinar. Our topic today is drafting your club's investment policy statement. This is a document that your club will jointly create that will help guide the investment decisions that it makes in the club's portfolio. It's a very important tool to make sure that all of your club members are on track and in sync as you're making decisions about which securities to buy and sell for your investment club portfolio. An investment policy statement is a document that's traditionally used in the financial industry by financial professionals such as portfolio managers, mutual fund managers, pension fund managers, other institutional investors. They will create this investment policy statement, or IPS, as a document that outlines the goals and objectives and criteria that's used to select investments to reach those goals. This will help make sure that the customer and the financial professional are on the same track with respect to the way the funds are managed in the portfolio. Now, an IPS could also include topics such as the targeted asset allocation, acceptable risk tolerance definitions, how the portfolio will be rebalanced. It can be very detailed. It can be more of a summary document. But in any case, it's considered one of the best practices for professional investment managers. And if you're ever in a position where you're hiring someone to manage your personal investments, you should definitely make sure that you work jointly to create the investment policy statement that will govern how your funds are managed by the professional. So why does an investment club need an investment policy statement? Well, first of all, it enforces consistency. It makes sure that everyone in the club understands the club's objectives, and that will help prevent the club from getting sidelined in investments that are not suitable for the investment club. Investment clubs often break up because of the inconsistencies that come when one member feels strongly that the club should invest in a certain way, others disagree. There's a lot of conflict. If you establish the parameters in advance, everyone knows what's acceptable and what's not. And this level of consistency that you can reach as a mature investment club is really key to your long-term performance. Evidence suggests that clubs that use a lot of discipline and a very consistent approach in managing their portfolio perform better over time than those clubs that take more haphazard approach, that are guided by emotion, that are guided by what someone in the club has heard from somebody else in the rumor mill about which stock is about to make a big move up. If you have the right tools and the right consistency, you're going to be more successful. And so codifying this in your investment policy statement is a great way out of the gate to help make sure that you're on the right path. Your investment policy statement will also help with member recruitment because you will only be recruiting members who support your approach, who understand your approach. They're not going to come in and say, well, but I've been successful day trading commodities, so I think maybe we should take a look at that. If the rest of the club is not on board, if the investment policy statement says we're going to stay away from commodities and focus on common stocks, then you eliminate that problem right away. So you're going to take some time to create your investment policy statement. I don't think necessarily it's something that's going to happen overnight or at a single club meeting. I think the club should spend some time, maybe a meeting or two or three, to discuss what they want to achieve in the club, to put it down on paper, what their objectives are, the ways that they expect to reach those goals. You might convene a committee and task them with going out to draft the statement for discussion and then bringing it back to the club for further review and final adoption. If you're a newer club, you might want to create a more general statement at first and then refine it over time by incorporating the knowledge that you gain as you learn by doing in your investment club portfolio. So don't sweat it if as we go through this, you think that some of the topics seem much more advanced. In time, you will understand more and more, and you can come back and adjust and refine your club's investment policy statement. Now, there are several sections that are probably going to be included. There are others that may possibly be included. I purposefully don't provide a sample investment policy statement because I think it's important that you and your partners go through the process of creating it on your own, creating something that's customized to your experience, to your level of expertise, and that will grow with you over time. So some of the sections that you would include might be your investment goals and objectives, the allowable types of assets, the target asset allocation, the risk tolerance, the portfolio and rebalancing guidelines, the minimum amount that you might invest in any security, the maximum commission you might pay on any purchase, your stock selection guidelines, your stock sell guidelines, and any other considerations that your club feels are important. Let's go through these one by one and we'll take a look at what we mean. First of all, your investment goals and objectives. These can be defined in such a way that all of your club members understand them. So I've got some samples here that in many cases may overlap, may mean the same things, just saying it in a different way. And again, it's important that you find your words to describe your club's approach. So something like achieving long-term growth of the club's assets. That's a great, very high level definition. A little more specific goal might be invest in securities with high expected capital appreciation. Again, that differentiates the types of stocks that you're purchasing that might exclude many dividend paying stocks. Another goal might be attain total return that outperforms the broader market. And again, simply saying total return, we haven't defined the securities. Many types of stocks might fit that particular objective. You may actually have an objective of seeking a higher yield or more current income from your partnership. That's rarer in most investment clubs because the investment club itself becomes part of the equity exposure of the partners in their personal portfolio. And so if you've got too much going on in the club portfolio, that makes it tricky for people to maintain their own disciplined asset allocation in their personal approaches. So as most investment clubs by design are focused on long-term investment opportunities, that's probably a good place to start as well with your objectives, to make it known that you're looking at a horizon that's perhaps greater than 5 years down the road, and take that into consideration as well. Now, you will also, in the allowable types of assets, you might also exclude certain types of assets from your investment club. You may leave it more open and decide as you go, but certainly you might consider allowing or not allowing stocks, ETFs, mutual funds, options, bonds, commodities. Now, many mutual funds may own stocks, but they can hold other types of assets as well. So simply saying a mutual fund doesn't exclude your club from purchasing a bond mutual fund or mutual funds that own other types of assets. So you want to be specific. And the same could be said for ETFs. Often there are ETFs that are more leveraged. There are ETFs that hold stocks. There are even managed ETFs as well as index ETFs. Options, many clubs will exclude options expressly. Bonds may be excluded as well to simply focus the club on the capital appreciation aspect of a stock portfolio. Commodities are typically excluded. Again, some partnerships in some areas of the country have more exposure to different types of commodity investing, and your members may have more experience. So again, it depends on all sorts of factors. If you have no clue how to go about trading commodities, then perhaps you want to restrict them from your club portfolio. You could still spend time in your club meetings learning about different strategies, learning about different asset investing methods, but you wouldn't necessarily own them in your club portfolio. So most clubs are investing solely in stocks and common stocks, perhaps allowing funds and ETFs in some cases. We often talk about clubs that like to have exposure to financial stocks but feel like they're too complicated to analyze with some of the metrics. So a broad-based financial ETF might be a placeholder for the financial stock exposure in your portfolio. Likewise, some clubs founder when they try to figure out how to invest in small company stocks, so they might own a small cap ETF. So there are all sorts of ways that you can stick to a 100% stock investing strategy using funds and ETFs. Now, due to the accounting complications and especially the tax reporting complications of some types of securities, we suggest that investment clubs stay away from real estate investment trusts, limited partnerships, master limited partnerships, royalty trusts, commodity ETFs. These are special ETFs that own the actual underlying commodity. They don't own companies that make commodities, but they might own, for instance, a gold ETF might own actual gold assets. Those are on our restricted list as well, and other non-operating companies, closed-end fund investment companies. Many times, these require your club treasurer to make manual adjustments to your records and/or your tax returns. They might require you to file tax returns in additional states. They might require manual adjustments that are going to be time-consuming and not supported by our support staff at My iClub. We're not going to be able to give you a lot of help if you're investing in these types of securities. Some of them, like real estate investment trusts, are just require a little bit of extra help, a little bit of extra work. You can do it, but you can run into situations where if someone withdraws during the year, that they may not get the full benefit of investing in that real estate investment trust from the distributions that are made, because you won't know until the end of the year. So there are all sorts of problems in different ways with those types of securities. So we suggest that you stay away from those types of assets within your partnership. Now, the asset allocation section might include how much of your portfolio is to be invested in different asset classes. As I mentioned already, my suggestion is that investment clubs should be 100% invested in stocks. That should be their goal. And I suggest that for a number of reasons. Some clubs like to maintain a certain balance of cash in their portfolio to cover unexpected member withdrawals, for instance. That is, I see the rationale behind that. I think that most clubs overestimate the impact of trying to raise cash in other means. They think it's too hard to raise cash to pay off a member withdrawal or a partial member withdrawal, but most clubs definitely have stocks that are underperformers that they're holding on to and have held on for too long that could be or probably should be sold, and a withdrawal is often a time to exit those stocks, pay off the withdrawal, and then reevaluate if you want to repurchase those stocks, since they are cheaper than when you purchased them in the first place in most cases. So it gives you an opportunity to do some portfolio management. So if you're stuck on whether or not you want to maintain a particular cash balance and have a target in your investment policy statement, I would suggest that it's not necessary, and that if you state your objective is to be 100% invested at all times in stocks, I think that's perfectly fine, and you can, but again, you can adjust that as you see fit in your own investment club. The risk tolerance section might identify levels of volatility that the club is comfortable with, and risk. When we talk about risk, we mean a lot of different things, and different people understand risks to mean different things to them. I think that you might acknowledge in your investment policy statement that there are short-term risks of investing in the stock market, that stocks have near-term volatility, but that over the long term, you're going to offset those risks with a higher level of reward. And again, stating that in your investment policy statement kind of lets you stake a flag in the sand and says, this is what we believe. And so people who are worried about where the market's going in the next 6 months take a backseat to the club strategy of trying to find opportunities that you can buy today that in 5 years from now will be much appreciated in value. And you could also indicate that your club intends to hold through bull and bear market cycles, that you're not trying to time the market, that you don't intend to sell when the market starts to go down, because you're never going to know when or how far the market is going to go down before to jump back in. Market timing is notoriously difficult to accomplish. Buying and holding throughout the cycle tends to be more successful. So you don't want to get spooked out of the market when it starts moving up and down, as it often does. In terms of portfolio and rebalancing guidelines, you can certainly set out how the club aims to diversify its holding. You can identify maximums and minimums that can be invested in different company industries and sectors and by company size. There are commonly 12 sectors of companies in the market. A well-balanced club portfolio might own 7 to 9 of those sectors. Some of those sectors, like energy and utilities, conglomerates, depending on the definition of the data provider you're using, are not as relevant to individual investors in a long-term oriented growth portfolio. But certainly you want to spread out your holdings, and I think 7 is probably a good place to start, a good minimum number of sectors to hold. You might also discuss how rebalancing would be accomplished. My suggestion is that you don't every year sell your best performing stocks to reduce your exposure in those industry sectors and companies to bring the portfolio back into balance, because you end up selling often the companies that are performing the best. And then you're left with a portfolio of companies that may be underperforming for certain reasons. So my suggestion is a more of a target rebalancing, that when you identify situations of imbalance in the club portfolio, that you establish a direction for future investments that will offset that imbalance by boosting other areas of the investment portfolio. Betterinvesting's guidelines are to diversify by company size. So you include 25% small, 25% large, and 50% mid-sized companies in your portfolio. This focuses your club portfolio into into holdings that have higher growth potential than in large or mega cap stocks where too many clubs focus on. Also diversify by sector and industry, spread it out as much as you can. The minimum investment amount is something that's also important to consider. My suggestion is that no holding be less than 3% of your portfolio, because if you're holding on to stocks that make up 1%, 1.5% of your portfolio, if they double overnight, if they gain 100% overnight because of something that happens, your portfolio goes up 1.5%. You don't get a benefit from holding a tiny position in a stock. Yes, if it goes down 50% overnight, your portfolio barely notices, but you're still doing your portfolio management tasks, you're still monitoring that stock every month, and it's a distraction when you hold a lot of smaller companies. So my suggestion is that you focus on a portfolio of no more than 20 stocks until you get to be into the 7-figure range, and then you might add some more, with no holding being less than 3%, and that you invest a minimum a minimum initial investment in any security that will grow as the company gets bigger, as your club gets bigger and bigger. By that I mean a lot of clubs start off saying, well, when we have $1,000, we will buy a stock. We won't buy any less than $1,000. When that club has a portfolio worth 400 or 500,000, again, investing $1,000 at a time is meaningless to the long-term success of the portfolio. So you want to have larger investments, or if you're not making them all at once, a plan that every month you're going to invest a certain amount to get to take advantage of the concentrated effects that you'll gain by having a portfolio that's focused on fewer stocks with larger positions over time. Back in the days when brokers charged commissions, the suggestion was that your commission would never exceed 1% of your purchase. And we would occasionally, I would come across clubs that were spending $20 for each purchase, and they were investing in $300 and $400 initial investments amounts. And that's just too much. Commission is just eating up too much of your capital when you're starting out. It puts you in too big of a hole, and the club was wondering why they never seem to be making much progress. And that's because they should have been waiting till they had $1,000 or $2,000 and then invest or find a cheaper broker. Today, with no commission brokerage is becoming more and more popular and accessible, it's a little bit less of a concern, but I would still suggest that you maintain a certain minimum amount that you purchase of any stock. This also helps the club say, well, let's see what happens. Let's just buy a little bit of it. When you do that, if the stock goes up, you say, well, gosh, we were right. We should have bought more. If it goes down, you say, well, it's a good thing we didn't buy more. Either way, you've learned something, but the club portfolio hasn't been affected. So when you say we're going to stake each investment that we make to a certain minimum level, if that's $5,000, $10,000, whatever it is, then you're committed, because you don't just say, well, let's just buy a few $1,000s worth. Now the club is a little more committed because you've got a guideline in place for the minimum amount that you make. You should also summarize your stock selection guidelines, the criteria that you will use for individual stock selections relative to the style of the club. Of course, the Toolkit 6 Betterinvesting approach uses the stock selection guide, and certain elements like this: having positive historic and good projected sales and earnings growth, having stable or growing pre-tax profits, selling at a reasonable PE ratio, having a reward to risk ratio at the current price of greater than 3-to-1, and a total projected possible annual return greater than 15%. Those are the basic criteria. You, of course, can add your own, express them as you see fit. If there are other rules of thumb that you wish to apply, you can include those. Again, and I wouldn't necessarily mandate the criteria, but simply identify the criteria that is used. One of the things about a growth strategy when you're looking at individual stocks is that during the late stages of bull markets, stocks become more expensive, so you focus more on the valuation side, and you may wish to purchase a stock even if the PE ratio is a little higher than it had been in the past. Again, all things in balance, some things kind of cancel out, and you may subtly shift your approach during different market cycles, but still maintaining the general course and speed that's set in the investment policy statement. The stock selling guidelines might also be included. Certainly that the basic guidance for selling a stock when the holdings are overvalued, when there's deteriorating fundamentals at a particular company, when the prospects are uncertain for future growth, or if you are selling to achieve a specific target diversification, identify those factors. You might also include a statement that says we don't sell stocks purely to take a profit. We don't sell stocks purely because it's reached a certain target price. Our growth stock approach means that as the company grows and gets bigger, the potential high price increases as well over the long term because we're starting from a higher starting point. So on a stock selection guide, for instance, you may see that the stock never gets in. Rarely will stocks get into the sell zone. They often will only do that when they are experiencing fundamental problems. They seldom do it on the basis of pure overvaluation because that indicates such a high PE ratio that investors kind of shy away from it before that condition exists. So that's how we can have future high prices that increase month after month or quarter after quarter, year after year, as the price of your shares, the value of your shares increases as well. So you can definitely think about this. And again, if you're a newer club, you may be broader rather than more specific at the start. And then finally, other considerations that your club might consider. It's completely within the purview of your club to adapt and adjust and create your IPS as you see fit. Some practices that you maybe shouldn't engage in, like using dividend reinvestment plans, or dividend reinvestment programs offered by your broker. Your treasurer will thank you for not doing this because dividend reinvestment plans create a lot of tax lots that have to be reconciled when you sell shares. And so again, it just complicates the treasurer's job. There's more work. You should definitely take your dividends as cash, put them into the capital, and then use that capital to purchase more securities the next time you do. But we don't recommend using dividend reinvestment. It makes things more complicated, and you'll get the same benefit over time by simply taking the dividends as cash and repurchasing other securities at the same time. If you are interested in ethical investing or socially responsible investing or green companies, or if you have decided that you're going to be a vice stock investor, so you're going to go after companies that other investors might avoid, like tobacco stocks or gambling stocks or firearms manufacturers or any of the other kinds of companies that fall under this vice stock category. Again, you should identify that here, or if you won't wish to avoid those types of companies. And I would also suggest that you set out 5 to 10% of your portfolio at any point in time that could be invested in more speculative securities. The founder of Betterinvesting, George Nicholson, actually wrote about this and suggested that clubs set aside money for IPOs or for companies that didn't fit the framework that the club had established for the rest of its investments, and limit it to no more than 5 or 10% of your entire portfolio. But go ahead and try to invest in some other different types of securities, and when they work out, they can add a nice boost to your total return. When they don't work out because they've been isolated, they're not going to take your entire club portfolio down with you. So I would suggest considering that as well, and putting that little provision in your investment policy statement. So especially if you're a new club or a younger club, it can be worthwhile for you to review your investment policy statement after the first couple of years of operation. As you learn more, you might want to make some adjustments there. And certainly once we get through 2020 and into the next bull phase a little more sure-footedly, I would suggest taking a look and adjusting it with what you've learned from being in your club during the massive 30+%, 40% decline of the market in the first half of 2020, and then the subsequent return for many stocks in the market. So use that as a learning experience to update your investment policy statement and include knowledge there that you want. Now, an investment policy statement is not an overview of your club. It's not meant to be a history document. It's not meant to be a description of how your members may join. It's not part of your partnership agreement or your bylaws. However, you may wish to reference it in your operating documents, and just note that we do have a separate investment policy statement that provides overriding principles that we follow in making decisions for our club portfolio. But as long as you focus on investing in portfolio management and not club operations, then you'll be fine. You just don't want to be setting precedent in your IPS for procedures about club operations that might conflict with what's in your partnership agreement and or your bylaws, your other operating documents. So you can search the internet for investment policy statement example, something like that, and you can find some samples that you can review. Again, a professional financial manager may have may create an investment policy statement that's 40, 50, 60 pages long. You know, I would suggest keeping it to a couple of pages is plenty for your club. We don't want to be so restrictive, but we want to provide the right balance of insight and guidance so that all members understand it. Don't try to create a perfect plan right away, and remember, you can modify it over time. So start general, add in more specifics. And just keep in mind, discipline is really important as an investor in the stock market. It's probably more important than whether you're a trader, a technician, a fundamentalist, a value investor, a growth investor. Different styles will work at different periods in the market cycle, require different amounts of effort, can all be successful. But if you're not disciplined, then your chances of success will decline. Here are a couple of resources. You can find the links in the handout or search on these websites to find investment policy statements and articles about them that might provide some additional resources for your particular approach. So I want to thank you for joining us for this webinar. We'll look forward to seeing you in our next ICLUBcentral Investment Clubs webinar. Find us at iclub.com. Visit us there. Check out our web-based investment club accounting suite at myiclub.com, and feel free to email me with your questions and comments about this webinar, suggestions for future events. I want to thank you. We'll look forward to seeing you next time. Have a great day.